The Fed continues to inject money every single day. Like a patient on life support, the Federal Reserve is literally keeping the markets alive. We can pretend that everything is okay, but fairy tales are best left for cinema and bedtime stories. The level of intervention by central banks is quite frankly unprecedented. It has never been done before on this scale. The inflation is popping up in equities as we see corporations flush with cash and have gone in the direction of financing their record level stock buybacks with debt. Unfortunately, the bigger this mess gets, the worse the reversion to the mean will be. You came here for the truth, so let me unveil that for you. I have a really interesting video to get into today. A lot of information that is contained within will not be found generally within the financial industry. They're not going to talk about this stuff. I wanted to bring it to you because it does relate. And of course, with every individual, they've got their pension funds, they've got their 401ks, they've got their retirement and their savings, and they want to know what's happening. Well, I'll show you the reality. Let's go into it right away. Fed adds $111 billion in temporary liquidity to the markets. When you see this level of intervention, you know something is wrong. It's not just 1 day or 2 days or 5 days or a week or a month. We've been going on for quite a while and the problem seems to be getting worse. We are going to find out, I believe it is tomorrow at the time of this recording, where we will hear Powell speaking and perhaps get some insight as to where the Federal Reserve is heading for the future. I do believe that we will see some intervention all the way into next year, but of course that remains to be seen. As always, you can see that information directly from the Federal Reserve's website, the New York Fed, that is specifically. And if we zoom in closer, you will see how they came up with that 111 or 112 basically billion dollars. Remember that although it is temporary in some cases, not in all cases, if you look at this, depends if it's the term repos or the overnight repos. Regardless, this just shows you that at this moment, the market needs somebody to be there. And of course, the real players are not available to make this happen. The Federal Reserve needs to be there in order for it to stand. One of the primary factors for why stocks have done what they have been doing over the last few years has been stock buybacks. That is very clear. We've already determined that they have been the biggest buyer since the financial crisis. If you look at the last cycle, what occurred essentially going into 2009, there were no stock buybacks. And why? Because they were worried about the prices falling. It's not as if the stock buybacks continue forever. As soon as these corporations feel that now is not the right time, they stop buying back. And this is going to happen again at some point in the future. But for right now, we are at record levels, and that has significantly pushed up the prices of these particular stocks. If you look at the Buyback Index, so basically the group of stocks that are doing a lot of buybacks, they have outperformed the rest. Okay, so it just shows you right now how this works. Cheap money, corporations issue debt, investors buy that up. Corporation is able to buy back their own stock as they see fit, and they've been doing so clearly at a rate that we have never seen before. Now, this just shows you something out of real investment advice. The long-term trend for the S&P 500 looks like they have overextended themselves considerably. Now, does that mean that the stocks will go down? Not necessarily. It depends on the events. However, if we look at this from the lowest point, 666 on the S&P, compare that to what we have seen all throughout, and there is a very big issue happening right now. The markets are clearly overbought. I'm going to show you some stats in a second, but I wanted to show you this first because, as they say, a picture is worth 1,000 words. Take a look at it just to give you an idea of the previous instances in which we have seen a clawback in the market. One of the big issues nobody wants to talk about is the VIX, and you could see how many people have their short position on the VIX. That is the orange section at the bottom there, and it's a record level. That should not be a surprise to anybody because the anticipation is that the Federal Reserve is going to backstop any losses, and this is when you know that investors have become entirely complacent. You can't do this at any moment. There's no time to ever be complacent as an investor. You always have to watch what you're doing. You could not blindly invest. If you do, eventually, it might come 10 years or 20 years or whatever it is, you will be wiped out. There is no such thing as a permanently high plateau. So Bank of America provided this chart, and you can see all of these different metrics that are trading above their historical average. So I'll pull out the highlighter here just to give you an idea which one here. Percentage above or below the average. There is only one on this list that is below the average. And if you look at all of these, whether it's the PEs, whether it's earnings, and so on, there's so many things. We've gone into territory in which we've never been before. We've surpassed the financial crisis levels, the dot-com boom levels. We're talking about 1929 insanity, roaring 20s insanity, and it's not going to stop. With the Federal Reserve injecting all of this money, it's creating the biggest bubble that we've ever seen before. Just imagine what's going to happen to the pension funds. It's going to be brutal for a lot of people, and I don't know what they're going to do to resolve it. Is the Federal Reserve going to have to bail out the pension funds? I'm not so sure about that. It's as bad a time for the global economy as any since the end of the last recession. That's according to two separate surveys. Now check this out. The IHS Markit Global Business Outlook. They survey 12,000 companies 3 times a year. It fell to the lowest since 2009. Now, that was the first collection of the data. So we don't have it going any further back, but at least at this point, it's the worst it's been. And there's been so many indicators that has shown us that as well. The IFO World Economic Outlook, which surveys 1,200 people in 117 countries, fell in the fourth quarter to the worst level since the second quarter of 2009. So these happen to correlate with each other, and it just shows you, depending on where you look, you can find the statistics that bring a whole new perspective in comparison to what we see in the stock market in the US, for example. In fact, if you look at the All Country World Index, we are finally getting towards the level where it peaked out in January of 2018. It's been basically 2 years in order to get back to that high. That's not a good sign when you look at this on a global level. We've seen this really terrible economic stagnation that's been going on, and they don't want to talk about it. They are simply putting it off, and they will use those 1 or 2 statistics that look oh so rosy. But you have to look deeper. And if you're not willing to, then you're always going to get blindsided. That's simply the way it works. This is just a chart that corresponds to that information and essentially showing us what I have shown many times before, and that is from 2008 into 2019, we see this contraction going on. It's evident in the PMIs, it's evident in so many other statistics, but here it is on this particular chart. CEO versus confidence composite survey, and the orange line is the CEOs, and you could see the consumer confidence is the purple. Now I wanted to show you something here because there's a divergence in between the two that we see present today. Take a look at this. You could see what's going on with the consumers. They think everything is fantastic. However, CEOs don't think that's the case, and we have seen this a couple times before. Check this out. When you look at the consumer confidence leading into the last recession, hey, everything's fantastic until they officially admit that there's a recession. Same thing has happened in every previous case. We are watching the consumer being the very last to figure it out. And the CEOs, obviously, they have inside knowledge. They know, okay, now we're seeing a little bit of slowdown that's going on in that country or this country, and these statistics and those indicators. And so we're going to cut back a little bit. And then the people start feeling it, and then that of course takes a turn on the economy, and it's a self-fulfilling prophecy. There's no telling when we will see a downturn, obviously, but individuals are preparing. Check this out. Wealthy people around the globe are hunkering down for a potentially turbulent 2020. This is according to UBS. A majority of rich investors expect a significant drop in the markets before the end of next year, and 25% of their average assets are currently in cash. And that tells you what's happening with these individuals. We're talking about high net worth individuals. These people are obviously more aware than the common investor. The rapidly changing geopolitical environment is the biggest concern for investors around the world. They see global interconnectivity and reverberations of change impacting their portfolios more than traditional business fundamentals, a market change from the past. This is what's happening in this case here. Who knows what will happen in the coming year with the Federal Reserve reducing the value of the currency along with all other central banks around the world. We will see how that affects the price of different things, whether it's commodities that you have to buy on a daily basis or whether we're looking at assets like housing and equities, but it remains to be seen how this will affect the average individual. Further down in the article, nearly 4/5 of respondents say that volatility is likely to increase, and 55% think that there will be a significant market sell-off before the end of 2020. It goes on to give you more details, but I think you got the point. Individuals who are aware somewhat of what's happening, they're paying attention, they feel that now is a good time to diversify their assets. They're not selling off everything and going down to run into their bunker and they're hiding there for the end of time. No, they're making changes to their portfolio. This is what individuals do in every cycle, the ones who know what's going on. Some people are too early, others though are too late. You have to decide what you think is best. And then I wanted to cover this really quickly to show you the Chilean Peso, this country right now suffering big time, really big time. You can see what has happened with the currency. If I pull this one up first, it'll show you the short term. You could see that it has tumbled, okay? We're looking at 800 to the US dollar right now. Previously, just a few days ago, it was at 740. So this has really started to tumble down and it's at the level, actually worse than the level it was at 20 years ago. And there's been some turmoil along the way. Back in 2000, it really hit that bottom. It started to come up again around, let's say 450. It peaked out just before the financial crisis, but now it's at 800 to the US dollar. The people there are certainly going to be hurt by what is going on. And I brought this up because you can see it going on all around the world, whether it's Hong Kong, Chile, Lebanon, Ecuador, and so many other places. Individuals are never prepared for a crisis, and that can come in all different shapes and sizes. So the moral of the story is be ready. If you found this video informative, hit the thumbs up button. When you do so, you are supporting me. Thank you very much. If you want to learn how to make money, if you want to learn how to build a business, I teach you in this e-course, which is free. I created it for my subscribers, showing you the system of Amazon, how it works. It's at the AmazonGPS.com. If you want to learn about the financial system, if you want to actually get a financial education, you read these two books, you got the entire foundation down packed. I've had people that work in the financial industry tell me that if everybody, as part of their colleagues, would read this book, they would learn a thing or two. So check it out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Wait a second, don't go anywhere. This is what you need to know. This video covers so much important information, and unfortunately not enough people have watched it. If you missed it, you definitely want to click on it. I'll see you there.